A Vanguard study found that the average investor underperforms their own funds by about 1.5% per year. Not because the fund performed badly, but because they chose the wrong type of fund for their situation and pulled out at the wrong time. The fund did exactly what it was designed to do. The investor just didn't understand what they'd signed up for. So the question isn't which fund has the best marketing, it's which fund actually fits you. If you've ever tried to figure out where to actually put your money, you've probably run into a wall of jargon. Index funds, ETFs, mutual funds, hedge funds. Everyone seems to have a strong opinion. Your coworker swears by ETFs. Your uncle won't shut up about his mutual fund. And somewhere out there, someone is telling you hedge funds are what the real investors use. The truth is simpler and more useful than any of that. These are just different vehicles. Like cars, some are built for speed, some for safety, some for hauling cargo, some for going off-road. None of them is universally best. The right one depends entirely on where you're trying to go, how fast you want to get there, and how much turbulence you can stomach along the way. So let's break each one down. What it is, how it works, what it costs, and what kind of investor it actually makes sense for. By the end of this, you'll have a clear mental map, not just of the jargon, but of the actual trade-offs. Let's start with index funds. An index fund doesn't make any decisions. That's the whole point. It simply tracks a market index, the most common being the S&P 500, which is a collection of the 500 largest publicly traded companies in the United States. When you buy an index fund, you're buying a tiny slice of all of them at once. Apple, Microsoft, Amazon, Google, and 496 others. There's no fund manager picking stocks, no research team, no strategy. The fund just mirrors whatever the index holds and rebalances mechanically when the index changes. Because there's no active management, the costs are extremely low. We're talking annual fees as low as 0.03%. That's 3 cents for every $100 you invest per year. The risk profile here is what you'd call moderate to long term. You will experience market downturns. The S&P 500 dropped 50% during the 2008 financial crisis. It dropped 34% in a single month in early 2020. But over long time horizons, 10, 20, 30 years, the historical trend has been upward. This is a fund built for patient investors, people who want steady, market-matching growth over decades without paying much for it. The reward is consistent, compounding growth. The risk is that you ride every market dip without a safety net. Best for long-term investors who want simplicity, low cost, and are comfortable holding through volatility. Next up, ETFs, or exchange-traded funds. An ETF is, in most practical ways, extremely similar to an index fund. It pools money from many investors and typically tracks an index. The key difference is in how you buy and sell it. An ETF trades on a stock exchange throughout the day, just like a share of any individual company. An index fund, by contrast, is priced once per day after markets close. For most long-term investors, this distinction is minor, but it matters in certain situations. If you want more flexibility in when you buy or sell, or if you're using more advanced strategies like stop-loss orders. ETFs also tend to be slightly more tax efficient than traditional mutual funds in certain structures. The fee profile is similar to index funds, often extremely low, especially for broad market ETFs. There are also ETFs that track specific sectors, technology, healthcare, energy, or specific strategies, which can come with slightly higher fees and higher concentration risk. Risk profile, same moderate, long-term range as index funds if you stick to broad market ETFs. Narrows and concentrates if you venture into sector-specific or thematic ETFs. Best for investors who want the simplicity of index investing with slightly more trading flexibility, or who want targeted exposure to a specific sector. Now, mutual funds. Mutual funds are the oldest of the four. They've been around since the 1920s. Like an index fund, a mutual fund pools money from many investors. The difference is that most mutual funds are actively managed. There's a professional fund manager, sometimes a whole team, making deliberate decisions about what to buy and sell, trying to outperform the market. That expertise costs money. Actively managed mutual funds typically charge between 0.5% and 1.5% in annual fees, sometimes more. That might sound small, but over 20 or 30 years, those fees compound against you in a significant way. That said, mutual funds aren't a monolith. Bond mutual funds, international funds, and some specialty funds serve genuine purposes for specific portfolios, and some active managers do outperform. The challenge is identifying them in advance, which is harder than it sounds. Risk profile varies enormously depending on the fund's mandate. A conservative bond mutual fund carries very different risk than an aggressive growth equity fund. You need to read what the fund actually holds. Best for investors who want professional management are investing in categories where active management can add value, like certain bond markets or international markets, and are comfortable with higher fees in exchange for that management. And finally, hedge funds. This is where things get genuinely different. Hedge funds are private investment partnerships and they're not available to everyone. In most countries, you need to meet specific wealth or income thresholds. In the US, that means a net worth of over $1 million, or annual income above $200,000. They're built for what regulators call accredited investors. Why the restriction? Because hedge funds use strategies that carry significantly higher risk. Short selling, betting that a stock will fall. Leverage, borrowing money to amplify positions. Derivatives, arbitrage strategies. These can produce extraordinary returns. They can also produce extraordinary losses. The fee structure reflects the complexity and exclusivity. The traditional model is 2 and 20, 2% of your total assets every year, plus 20% of any profits the fund generates. On a $1 million investment, you're paying $20,000 a year before you've made a single dollar of return. That bar for outperformance is extremely high. The performance record of hedge funds as a category has been underwhelming for the past decade plus, and this is important. The best hedge funds, run by the best managers, genuinely do things that no other fund can replicate. Market-neutral strategies, protection during crashes, access to private deals. For very wealthy investors with specific goals, they can play a role. Risk profile, high. Strategies can be aggressive. Liquidity is often restricted, meaning you can't always pull your money out whenever you want. These are complex instruments with complex risks. Best for high net worth investors who meet the accreditation requirements, have a sophisticated understanding of risk, and have specific portfolio needs that simpler funds can't address. So here's the landscape, plainly. Index funds and ETFs sit at one end. Low cost, low complexity, broad diversification, moderate long-term risk, and strong historical track records for patient investors. They don't promise to beat the market. They promise to be the market. Mutual funds sit in the middle. Higher cost, professional management, variable performance, and a wide range of risk profiles depending on what the fund holds. Some earn their fees, many don't. Hedge funds sit at the other end. High cost, high complexity, high minimum investment, and the possibility of both high reward and significant loss. They're built for a specific type of investor with specific needs. None of these is universally better. All of them have a legitimate place in the right context. Here's the framework that actually helps. Start with your time horizon. If you're investing money you won't need for 20 years, you can absorb short-term market drops. Index funds and ETFs make a lot of sense. If you need the money in 5 years, you might want something more conservative, certain bond funds or lower volatility options. Then think about your risk tolerance, not just in theory, but in practice. When markets dropped 30% in 2020, some people stayed calm and held. Others panicked and sold at the bottom. Be honest with yourself about which one you'd be. Higher potential reward always comes with higher potential pain. Hedge funds and aggressive equity mutual funds can deliver strong returns, but they can also deliver stomach-dropping losses. Index funds smooth some of that out through diversification, but they still fall with the market. Then look at fees. A 1% annual fee difference might not sound like much, but compounded over 30 years on a $100,000 investment, it can cost you $150,000 to $200,000 in lost growth. Fees are one of the few things in investing you can actually control. They deserve serious attention. And finally, match the fund to its purpose. Don't use a hedge fund strategy when a simple ETF will do. Don't use an actively managed mutual fund for a role that an index fund fills at a tenth of the cost. But don't dismiss more complex funds entirely if your situation genuinely calls for them. Every one of these funds exists for a reason. The question was never which one is best in the abstract. It was always which one is right for you, given your goals, your timeline, your risk appetite, and your fee tolerance. A 25-year-old with a stable income and 40 years until retirement has a completely different answer than a 55-year-old protecting wealth they've already built. Both answers can be correct. Know what you own, know what you're paying, know how much risk you're actually taking on. That's not complicated, but it requires you to stop listening to the noise and start asking the right questions about your own situation. If you want to keep building that kind of financial clarity, the kind that's actually based on evidence and not just financial industry marketing, stick around. That's exactly what we do here.